Good morning, Paul. Thanks for joining us on the M&A Diaries. For me, I really wanted to have you on this episode because I think the legal aspect of mergers and acquisitions and the transaction point doesn't necessarily get spoken about that often. It's almost like a necessary evil, if you like, in the background for a lot of people. And I know we laugh about it, but I think there's various individuals or business owners that we've worked on some transactions where lawyers for them are either a cost that they just know they need to have. Those that maybe do not understand the full extent of how you get involved and the value that you add as a good corporate lawyer, and others that for smaller transactions might say, oh, we don't need to use the lawyers, and really they do, for various reasons that we'll cover today. So yeah, it'd be great if you wouldn't mind just kicking off, get a bit of background on yourself and the types of transactions that you get involved with.
Yeah, firstly, great to be on the podcast, James. Pleasure to be here. You touched on a few things which are interesting. We'll come on to kind of the grudge purchase, and we're a cost, aren't we? We're a reduction of the consideration they're going to get off the sale side. Anyway, my background is I trained in London, qualified in 2009, the worst time in the history since the Depression to qualify as a corporate lawyer. I got offered to stay on at the firm I trained at as a prop lawyer, and I couldn't see a life of colouring in plans and arguing over title plans and stuff like that. So at that time, I moved to Ellison's, where I am now as kind of a 1 year qualified. To show you where the market was then, they were downsizing. They had just 2 partners in the team, and they were replacing a partner who was moving on with a 1 year qualified. So that's where we started at Ellison's, and 15 years later, still Ellison's, but that team has gone from 2 to 15, and the quality of work and the type of work we do has really increased in that time. So, we're not sort of niche lawyers, we're not niche accountancy lawyers or niche professional practice lawyers, although we do a lot of that work. We're probably sector agnostic, but just where we are in the market is transactions for owner managed businesses primarily, whether that be haulage or logistics, because where we are in the world, we've got the ports down to near some of our offices, so we have a lot of those transactional work and a lot of those kind of clients, or just getting in with a particular client. We've done a lot of travel work, we've done a lot of work in the insurance sector, and we have done a lot of work with professionals as well. Clients tend to be owner managed business, transaction size, anything from zero if we're working for our insolvency practitioners and doing distressed sales and acquisitions, up to, we've got transactions on at the moment over 100 million. So
yeah,
real wide piece. The vast majority are between 0 and 30 million, I would say. So that's
that
where
SME focus space, as you said.
That's it, yeah. Owner managed businesses, people who have grown their businesses up from scratch, either helping them grow by doing acquisitions, helping them with some tax-driven reorganisations, maybe pre-sale, and then hopefully an exit or an investment. That's our sweet spot.
Lovely. I really appreciate that. And I think it's good to give that context and background before we start moving into some of the deeper questions here. And obviously, as I said or alluded to earlier on, we've worked on various transactions together ourselves. So, and I love the way you approach things. And I think having a commercially minded corporate lawyer is super, super important, and something we'll probably come on to later on during the point of discussion. But yeah, I guess to kick off, in terms of when is, in your mind, the best point in which to engage you as a corporate lawyer in a transaction or pre-transaction, for you to best serve your clients? When do you think is the right time for them to start talking to you about a possible transaction coming up down the line?
Yeah, it's interesting. I mean, you touched it at the start, didn't you? That I think we've got to be honest in the industry, and we're seen as a cost. We're seen as very expensive. There is a fear amongst people who don't deal with lawyers very often that every phone call is going to be charged in every 6-minute unit, every email is going to be 6-minute, and it's just going to go on and on and on. So we approach transactions a different way, which hopefully I have the chance to come on to at the moment. But to answer your question, if I say, when's the worst time we get instructed?
Yeah.
It's a phone call from a client saying, I've signed heads of terms. Can you help me on this? And then you're thinking, okay, you're just hoping that they've signed up to sensible heads of terms, because especially if we're thinking sales side, the heads of terms are going to be drafted by someone who's, on the other side of a transaction. So we're in at that point after you've committed to heads of terms, then automatically I'm worried about what you've agreed to, what the terms you've signed up to. Do you understand what you've entered into? What provisions have you agreed to, which we would have advised you not to, or are not in the heads of terms? Heads of terms obviously don't tend to be binding, so there is some room to manoeuvre. But if you're as you know, if you renegotiate heads of terms, you're losing credibility, aren't you?
Yeah.
So
Yeah.
it's the answer which you'd expect me to say as a lawyer is the sooner the better. If we can get in really early when clients are thinking about selling but haven't had an offer, but they're looking at their roadmap, then we can do so much in advance to make the transaction easier. We can undertake pre-DD so we can find any issues before any buyer even smells or sees an issue, fix them, rectify them, do what we need to do to get those sorted, and then there'll never be an issue in the transaction. We can put things in place like incentive schemes for employees. So if you've got some employees who you really need to stick around to help you get to that value, to get the exit you want to get, we can structure those for you and put those in place so they will actually work for you on an exit, not be an issue on an exit of I've got to sort this person out. So the answer is the obvious answer you'd expect is as soon as possible, really. That's the answer.
Yeah, I think you kind of touched upon it there. People have got to realise that actually a slight investment up front is going to save you in the long term, both financially, but also in terms of a smooth transaction and deal happening. Whether you're on the buy side or sell side, that just add a little bit of preparation ahead of time, speaking with your advisors is really going to help over the course of that transaction.
Yeah, and there's an element of you don't have to try and fix things when you're in that real pressure of a deal. So, you've worked on loads of deals and you can see, especially a lot of our clients that own and manage businesses, they're running the business, still trying to drive the profit to keep the profit up to do the deal. And then they're being asked for loads of different things. Have we got employment contracts? Well, if you instruct us earlier, we can check you've got all the employment contracts, all your policies, all your leases sorted out, all your contracts in place. And then when the deal comes along, bang, there they are. They're good quality, they work, there's no issues from a legal perspective. And that investment up front will save you time, stress, and probably cost during the deal.
Yeah, I think people underestimate the huge distraction that going through DD is on a transaction for business owners. I mean, a pertinent case of it comes to mind last year or maybe 18 months ago, where we had a deal set up, all fine. About 6 months of DD, a month out from completion, because they had been distracted from the running of the business. The profitability had dropped, and that made the acquirer rethink. And unfortunately, we paused that deal, and they weren't able to complete. And that was just through lack of that preparation, as you mentioned there.
Yeah, I mean that's such a big thing when you're in the business, and that's why if you were like mapping out how to sell your business, one of the key things you do really early is get a management team in place. The easiest businesses to sell are the ones that sellers aren't in anymore because they're not important. It doesn't matter if they're not there because they've built a really strong management team who can do that. And the DD process, it's also about the question is, when do you get other people involved? If you're a small team and you're an owner managed business and you're in the business, who can I trust to help me with this DD exercise? This, 50-page list of questions I've got from the buyer's lawyers, the buyer's tax guys, the buyer's finance guys. Who can I help me do this? Who do I trust? Do I need to get an NDA in place with those guys to help me pull that information out and get it out? That's a really important point because every client that we see who sells has not sold before. We stress that it's really stressful, it's really hard work, and it's personal as well. This is your business, you've set it up, and you've got
Absolutely
some lawyer somewhere saying you haven't done that right. Where's this policy? Where's that contract? Oh, you should have that. And it's hard not to take that personally as well.
Yeah, no, absolutely. And I think the key points there are it can be costly both financially, but costly stress time wise as well, and ultimately could have an impact on your reputation and the vision or the perception that the acquiring party has of you. Or if you are the acquirer, if you've not got all your stall set out and ducks in a row, the selling party may well have other thoughts about do I really want to get in bed with these guys and transact and have them take over my business and lead it on to the next generation?
Well, that's particularly important in the accountancy space where there is such competitive tension amongst buyers. If you get a buyer come to the party and you've got multiple offers and one hasn't got all their stuff together, then you're going to think, well, am I going to trust my business to them, and I trust my staff with them? How are they going to treat people? How are they going to trust my clients? And a buyer who is well prepared, has a very smooth operation, has a clear plan for the business, for the staff, for the clients, is more attractive.
Yeah, no, absolutely, and it's getting ever more so competitive at the moment. And why sticking with accountancy practices, and obviously that was the point of this podcast anyway. But from a legal perspective and your perspective, what are the key documents that people should be thinking about, or areas they should be thinking about in terms of an accountancy practice transaction, both from a sell side and buy side?
Yeah, so either way, the way professional practices, accountancy practice, lawyers, insolvency practice, the value is in the clients and how the recurring fees basically, and the fees going forward. So first key point is client engagements. How tight are your client engagements? What are the terms? Can the fees go up and down, especially on recurring work? How long are they locked in for? That's the key. That's the value in your business. Second practical point, more on the legal point, but we are talking about business here. We are business owners, and we're trying to help business owners sell. Is what is the buyer actually buying? Because in professional practices, is that client a client of the firm or a client of a certain individual? Do you instruct Ellison's, or do you instruct a lawyer at Ellison's, for example? So then you're looking at the terms of that employee or partner, locking them in if you're a buyer, how long they're going to be around, what's their plans afterwards. If you're selling, you're going to be asked your fellow partners or your staff, what are their terms and conditions, what are their restrictive covenants, etc. So that's a really important point.
Absolutely.
I think, like any other industry, accountancy practices, the software is key. Compatibility of software, especially if you're the buyer. What systems has the target got in it? And if you're sales side, how good's your data? Like, how good is the data that you've got in your system? How clean is it? How easy will it be for the buyer to integrate that into their systems? And does it stand the test of time? And then finally, on the accountancy side, particularly the audit side, it's the regulations. It's making sure you fit in with the audit regulations and structuring the transactions so that if you need to be, or if you need audit, there's an audit business in there that it meets the regulations.
Yeah, and that's on the audit side. That's a big point of conversation at the moment in the industry, as you know, with some of the changes that are coming down the road, and obviously private equity and the ownership of those particular practices, how they're going to adhere to the new ICAW, ACCA, or regulations as well.
Yeah, it's interesting. The change to the guidance on the regulations is interesting. My interpretation of that, of the ICAEW, is that if it's a limited company, then an audit qualified person is going to have 75% if it's a limited company, because they have to have the right to change the constitution. So that traditionally it was structured as 50% just to have control. Now it looks like, so I think if you were sad enough, as I am, to look at Companies House and who's changing their articles, a lot of these private equity firms having to change their articles of the subsidiaries to give those audit individuals 75% of the voting rights in the audit entity.
Yeah, no, and we've already seen the splitting out of the entity, so that the main accountancy, bookkeeping, and compliance work will be done in one entity, and then there's an audit entity that's being set up now. But no, it is interesting to hear the stories of lobbying going on to the ICAW, but of course we know that's coming down from the FRC, not the ICAW. So yeah, it'll be interesting to see how that plays out over the next few months.
Yeah, I mean, it is interesting, isn't it, when you see these structures in place, because naturally you just think there's always a workaround, isn't there? And it is what they're trying to get in place actually working? Is it doing what it's meant to do, which is they want an audit professional to be in charge of that entity? But the reality is, if you've just got control, but you're talking to someone who's your boss above you, I mean, how much control do you actually have? Technically speaking, you've got the voting rights, but is it really achieving what they want it to achieve? I'm not sure if it is.
Yeah. Yeah, no, interesting. And then, yeah, thanks for pointing out some of those main documents, those key documents or areas that an acquirer or seller should be thinking about. Um, yes, I guess for me, it'll be good to kind of shine a light now on, from your experience on the legal side, the various pitfalls or troublesome areas that people could maybe get ahead of if they haven't walked the path before, that they should be thinking about and that you've seen time and time again.
Yeah, I mean, I think we touched on it to an extent before. It's just as prepared as you can be. Um, if you can run a kind of what we call a vendor due diligence purchase for your sales side, and basically get a lawyer to, it's a service we offer, is to basically go into your business as if we were buying it and say, okay, this is where your holes are, this is where your gaps are, you need these policies, these contracts need tidying up, etc., etc. That's great, but to be a bit more specific than that, the ones we see on a regular basis which cause significant problems is if you're selling the shares in a limited company and you've ever done a company buyback. This is like a massive red flag. In the last year, we've probably had 4 or 5 transactions which just come across this problem. There's a real history of people not doing those correctly. They're a statutory process, and if you haven't followed the statutory process, if you haven't got a contract in place, if you've not paid all the consideration on day one, if it's not out of distributable reserves, if the articles don't allow it, if you haven't got class consent and you need it, then that transaction is probably void. And then you get to the scenario when the buyer's looking at it and saying, I'm trying to buy all the shares in this company, but you did a company buyback to some ex-shareholder who's long gone, and technically speaking, he probably still owns those shares. We can rectify it. It's not easy, but the sooner you pick that up, the better. And it's just to give you an insight into how we work as lawyers. If we get an instruction, the first thing we'll do at company's house is go and see if they've done one of those. And if they have,
Right.
we say, all right, get us all the contracts you've got, all the paperwork you've got for that, because that's the first thing we need to check, because they're so often done wrong,
Yeah.
unfortunately. And the second one is not.
Sorry, Paul, just to interrupt there, but done wrong in what way? By the lawyers that they may have been instructed to carry that out? Or is that usually when the business owners have tried to muddle through it with their accountant, for example? Or...
Yeah. As soon as if you see a law firm, because you can tell who's filed the paperwork, because they're normally the submitter on the back of the form. If it's a law firm, I feel more comfortable. This is going to be very unpopular with your audience, but it's something. The ones that we have seen done wrong have been done by accountants who, I don't know, haven't followed the process exactly right. So the most common errors are no written contract. You have to have a written contract, and it has to be approved by the members. And the second one is people paying deferred consideration. The statute is very clear. The consideration has to be paid on completion. It cannot be deferred. It cannot be left outstanding as a loan. And if it is, you're in breach of the statute, and it's potentially void. It probably is void.
Okay.
And then you get into a discussion with the buyer about kind of how much of a risk is it. Obviously, very small shareholders, less risk. Some of them times we just redo them. If the shareholder's friendly, they're still around, we'll just redo them properly. We've had ones where the selling shareholder has been deceased. And there's the question is, do we go into the estate of that deceased shareholder and sort of tip them off that there's this issue potentially when we're about to sell?
Right.
And then it's really a lot of transactional work, legal transactional work, is allocation of risk. So basically, there's this error which has happened. Who's going to take the risk, the buyer or the seller? More often than not, it's the seller.
Yeah. No, I just wanted to unpick that just a little bit more for those that are listening in and try and understand where those pitfalls are. But it's, it's a prime example of, you've got people that are specialists in their certain professions. So the professions coming together and collaborating on a deal is going to make sure that ultimately it's best for whoever the client is, whether that is the accountancy practice firm that we're talking about now for today's conversation, or an SME business that maybe the accountants are looking after themselves.
Yeah, and the other sort of really common one we've seen over the last couple of years is COVID-based debt. So the bounce back loans, or the other loans that were available. So many people have them sitting there because they took them out because they were available. It's often just a thing we've got to get tidied up before completion. So if you're not using it and we can get it tidied up earlier, then that's another common. not
Yeah.
an issue. It's just a hurdle to get over.
I always find from my experiences, some of the transactions I've been involved in is stuff around property and leases is often something that either extends the period of time that you're talking about or can become quite problematic during conversations, mainly because it hasn't been dealt with ahead of time.
Yeah, so there's a classic structure, isn't there? Especially in professional practices, it seems really common that some of the partners will own the freehold or will have an interest in the building and they'll lease it back. There isn't a proper lease in place, or it's in the um, pension company of those employees. So yeah, and it's just not picked up, or it's just been left to roll on, and you're actually it's come to the end of its term and you're holding over and you need to negotiate a new lease because the buyer will want certainty. If the buyer wants the premises, it will want certainty. It won't want to rely on that relationship with the landlord that the company might have at the moment.
Yeah, yeah. No, I have that very scenario right now with one of the firms. It's been left, 3 weeks out, and all of a sudden it's like, okay, where's that lease? It's like, oh no, we've got a great relationship with the landlords. We've been there with them for 20 years. Well, that's great, but that's you guys, and you're about to leave the business in a year's time. So we need to get something in place, please.
Yeah, absolutely.
So no, always interesting. You picked up on a share purchase earlier on. It's often a conversation I have with a lot of our clients when either looking at a proposal or thinking about what the best course of action is for them, whether it be in a share sale or an asset sale. Yeah, it'd be great from a legal perspective if you could define both and the
Yeah,
differences between it.
no problem. It's a question we have very often. So very simply, it comes down to what you're selling and who's selling it. Um, if it's a share sale, the sellers are the shareholders, and the only asset that is moving, the only thing that's changing hands, is the shares in the target company. Um, so that means that if you're a buyer and you're buying the shares, you're getting everything that's in that company. Nothing within the limited company wrapper is changing. All the liabilities, historic liabilities, future liabilities, assets, goodwill, IP is just staying in the company, and all that's moving is the shares on the top. From a seller's perspective, it's really clean. You're getting rid of everything. You don't have to worry about that, and you're probably also getting that out at a capital rate of tax.
Yeah.
With an asset, don't worry, I'm not going to talk about tax. I'll leave that to you, to the tax experts. And I can't talk about buybacks and then start talking about tax. That'd be a hypocrite. Um, Asset sale, the seller is the company, and you're selling, that company is selling a list of assets. So from a buyer's perspective, it's great because you just cherry pick the things you want, the assets you want. In a professional practice, it's going to be the book of clients. The staff will come over under TUPE on an asset purchase. But from a seller's perspective, you're then left with all the bits the buyer didn't want, and the seller is the company. So the proceeds of sale go into the company. So you've then got to extract them from the company to get them out to the individual shareholders. Now that might mean a winding up of the company to get it out of capital rate, but it's an additional step you need to take to get the money out. And also you've got the issue of what am I going to do with this limited company and whatever the buyer didn't want left in it, whether that be assets, property they didn't want, or just potential liabilities. So really, it's a question of share sale. You're selling the shares. You're selling everything. Asset sale. The company is selling some of its assets to a buyer.
Yeah, thank you for that. And from from a legal standpoint, in terms of the amount of DD that may go into either, though, does it remain the same whether it's a share purchase or asset purchase, or is it a little lighter because you're just looking at a specific asset rather than the whole business?
Yeah, I mean, it depends on the scale of the asset sale. Generally, you'd like to think that an asset sale would have less DD because the DD should be targeted very much at the assets they're buying and the liabilities they're taking on. Really, the only liabilities they'll be taking on are the employment liabilities under TUPE. So the employment DD will be exactly the same, but the rest of the DD should be less and should be more targeted. Ultimately, it will depend on how much of the assets they're buying. If they're buying everything, they're just doing it as an asset purchase because they don't want to take anything they don't know about, then DD will be similar, slightly less, but not a great deal in it. Share sale, you'd always expect to have full warts and all DD just to
Yeah,
pick up historic liabilities that might be in there, really.
yeah. No, fantastic. And just before we move on, is there anything from a buyer or a seller perspective that they should really think about on what route to take on that share side or asset side from your
Yeah,
experience?
a buyer will always prefer, from a legal perspective, buyer will always prefer asset purchase. The real, but you're doing a deal, aren't you? It's a collaborative process, and the benefits of a share sale are so much higher for a seller in terms of getting the funds directly to them at a capital rate that will often drive the incentive for the seller is much greater than the issue for the buyer, really, I'd say. Because you can
Yeah.
get around the deed, you can get around the liabilities in the SPA, you can get the buyer protection for a share sale within the contract. If you had a choice every time you go for an asset purchase, but the benefit for the seller is normally so great that just pushes the deal in that direction.
Yeah. No, absolutely. We're talking of shares. One thing that does come up more often than people probably expect is the lack of shareholders agreements in place, and a lot of the time that does happen in professional practice space, regardless of them, advising their clients to do the same. But we see it time and time again where friends have set up an accountancy practice firm together. They've gone on a bit of a journey, and it comes to point of sale, and we've got no shareholders agreement. And then obviously, as we all know, when there's money involved or it becomes a bit tetchy in conversations, there's no point of reference to go back to. Um, It'd be great to hear in your words why shareholders agreements are so important and a document that people shouldn't overlook and really think about, either when they're going into business or realizing it during the course of their business travel, saying, guys and girls, we should all get together and actually make sure we get this document in place for a rainy day.
Yeah, well, exactly. It is for a rainy day or it's for a conflict, isn't it? It's in an ideal world, and we say this when we're drafting shareholders agreements or LLP agreements or partnership agreements, they're all effectively the same, the same thing. They're governing the relationship between the owners of the business. In an ideal world, this will go in a drawer and never be seen again. That's the ideal scenario, because the purpose of a shareholders agreement is to deal with issues that arise. It's to deal with the decision making process. So if there comes to a point in a business where there is tension and decisions aren't being reached, okay, what is the process? What is our agreed process for making decisions in this scenario? Who has a casting vote? What have we got reserved matters that need to go be approved by a certain percentage group of people? How are we going to get out of this, deadlock situation? What is agreed to happen if there is an exit or an investment opportunity? What are we going to do if there is an investment or exit? Particularly, what are we going to do if some people want to do it and some people don't want to do it?
Yeah,
How are we going to deal with the situation if one of our shareholders or partners wants to exit? What's he going to be able to do with his shares? If we've got no shareholders agreement and nothing particular in the articles, it's personal property. You can go and sell it to whoever. We don't want to go into business with whoever, so we want to keep that all nice and tight and make sure that if he leaves, we're getting those shares back. Either we're buying them back at fair value, or if he's done something naughty, if he's going to join our competitor, we want to be able to get them back for nothing.
yeah,
What happens if someone dies? It's really unfortunate to talk about it, but you do have to talk about it. Unfortunately, it's a fact, and it happens, and it can happen very suddenly. And are we happy that those shares are going to go into that estate, and we're going to be dealing with that person's partner or that person's kids? They're going to get the shares. Are we happy for them to have the shares, or should we have something in there that means we can get those shares back and the estate can get some cash, which they'd probably rather have than shares in a limited company? Do we need that to be insurance back to make sure there's the money available to do that on that person's death? And then if one of our partners was to leave, take staff, take key contacts, take clients, have we got some protection for that eventuality? So restrictive covenants. So really, it's like, when you're starting off a relationship, it's like a prenup, isn't it? At the start of a
yeah,
relationship,
absolutely. Yeah,
I love you, darling, but can you just sign this? Like this kind of thing.
yeah,
But in business, you've got to be realistic. People's lives will change. Things will happen in people's lives. They'll go in different directions, and you won't always get along. And for the cost of a shareholders agreement, which hopefully will just stay in a drawer and never be looked at, there is something there that if a problem arises, okay, these are the rules. This is what we're going to do. and this is how it works. And it
Yeah.
gives you that
Just
certainty, and that can help the business continue rather than just getting stuck in a rut, not being able to function.
Yeah, as you said, it just removes all emotion. Then it's there in black and white. This is how we're going to operate, and it's quite interesting. One of the points you made there is, if we were to go down the investment route or not, we're certainly seeing that with private equity coming into the market at the moment, and I guess the change in dynamics of age and age demographic for partners. It used to be, four individuals they're set up together, all the same age, and they'll go on an entire journey and career with them, and then they'll retire and just hand over their clients to whoever it may well be in the local area. But now you've got partners that might be 60, thinking about retirement. You've got those that are middle-aged, and you've got others that are younger but want to drive the business forward. And obviously, those that are younger are looking to reinvest to keep on pushing the business forward so they're not getting left behind. And then you've got the older partners that are thinking, why am I reinvesting right now? I've got 2 or 3 years left. So I want to maximize my drawings. So we're certainly seeing that a lot now, where the conversations are happening where private equity, or it may well be another, smaller independent firm that's looking to take over, or inject some investment, and the younger partners are kind of clashing heads, as you kind of said earlier on, with the older partners as well. So having that shareholders agreement, partnership agreement, just eradicates all of that. You go, this is the way forward, and this is how we can resolve this conflict.
Yeah, this is what we agreed to 5 years ago. Nothing's changed. There's no emotion. I'm not trying to take any money off you or push you out the door. This is what we agreed to. This is it. Here you go. Because the worst case scenario that happens there is, in a business, and a good business, you get a falling out at the top, and then nothing happens. No decisions are made, no investments are made, and then the business becomes less profitable, and then everyone loses.
Yeah, and also, as you said, on the deceased side, it's very sad to think about, but you need to protect yourself as business owners as well. If one of your partners does unfortunately pass away, as you said, where do those shares go, or where does the interest in the business go? It could go to their wife or their husband, whoever it may well be, and you don't necessarily want them having a seat at the table running the business because they've got no clue about an accountancy practice business.
No, exactly. And from your, if you want to, it's always uncomfortable killing someone off in the room, isn't it? But if you want to kill yourself off, do you think, does my estate want shares in this? My sons or daughters or wife might have no interest in this business, and they don't want to do it. They've got their own stuff going on. But what they would like is the value that I've created. So, put something in place where the other partners have got to buy my shares, and that money goes to the estate rather than some shares. And as long as that's insurance backed, it shouldn't be a problem to fund that.
Yeah, absolutely. Well, we've discussed a few documents. We've gone over heads of terms. We've done the asset purchase agreement and the share purchase agreement, as well as shareholders agreement there. From your perspective and your experience, what are the 3 top maybe overlooked things within those documents that are very, very pertinent and probably have big ramifications if they are overlooked within the transaction?
Yeah, so the sort of the key ones, I mean, the one that I see most often is post-sale engagement of the sellers. So you're exiting your business, but obviously, particularly in an accounting business, you are the value. These are your clients. You've built this up over 5, 10, 15, 20 years. So naturally, the buyer is going to want to keep you engaged. And that could be, so the first one is your employment contract, your consultancy agreement, or as part of the sale, you might be locked in for a period of time. I think it's really important for owner-managed business sellers to sort of be honest with themselves and think, am I going to be okay with being an employee? How am I going to feel when I've got to put my expenses in? How am I going to feel when I've got to justify that credit card statement? I've got to ask someone to spend some money. Got to do this, do that. It's incredibly difficult to do if you've been your own boss.
Mindset shift. Yeah.
Been your own boss for 15, 20 years, done whatever you wanted to do with the business. If you felt, right, we've got to go and do that right now, you've been able to do it. Whereas, particularly in accountancy, you're going into big structures, lots of corporate formalities to go through. So in terms of coming back to your question, that employment contract, that consultancy agreement, potentially that earn out on the SPA might be contingent on you staying a period of time. Is that realistic? That would be the first point I'd say is really key. Is kind of don't kid yourself about what you're going to be able to do. I'll be able to stick out for 2 years.
Yeah.
It's not uncommon for sellers to come to us with a couple of years after the deal going, can I get out? Basically,
Yeah.
it's true, unfortunately.
I've seen
Disclosures.
it. I've seen it sooner. I've seen it sooner.
Well, yeah, exactly. Yeah, with 1 week, 2 weeks.
Yeah. No, yeah. Usually a couple of weeks have gone by and it's like, no, this is maybe I've made the wrong decision.
Yeah, exactly. Yeah, exactly. So so not really a document, because it could be it could be as part of the earn out. It could be part of, considering the deferred consideration. It could just be an employment contract, consultancy agreement. But whatever it is, that post sale period of time, that's often overlooked. Disclosure exercise. The disclosure exercise is the second sort of piece, which I think is overlooked. We've talked about it a lot. It's really stressful. It's really hard work. But the better you do it first time around, the quality of your answers, the quality of the documentation you provide, that's your protection. That's your protection against a warranty claim, getting everything out there. And the better you do it first time, the quicker it will be. What we see quite often is people just trying to get rid of questions. I just get rid of it. I just bat it back with as little information as possible. But the disclosure exercise is your protection against a warranty claim. High quality answers, backed up by documentation, gives you more protection as a seller, and also makes the process smoother. Third point, not dissimilar to the first point, is roll up of equity. If you're taking equity in the buyer or in the buyer's group, it's very often those documents aren't negotiable, because there's 50 other people signed up to the same document who've all been rolled up. But that doesn't mean you shouldn't understand it. It doesn't mean that you shouldn't read it and get advice on it, because often they'll have, on a sale, we'll have restrictive covenants in the SPA, we'll have restrictive covenants in your employment contract. There'll also probably be restrictive covenants in those roll-up documents, in the investment agreement.
Yeah. Bad lever, good lever provisions as well. And yeah.
Exactly. You're rolling up some of your value into that. So you need to understand, how can I get out? Can I get out? When can I get out? What happens if, same point, it's effectively a shareholders agreement. So the same points that we made in the shareholders agreement, what happens if I die? What happens if I want to move on, etc. So those are the 3 points. I'd say: disclosure, making sure you do it properly, your post-sale relationship, and the equity investment piece.
Yeah, it's quite interesting actually, because we're a few years in now to some of the cycles to private equity coming to the market specifically. I know some of the partners that they've done their earn out period and they've left, but they've still maintained or retained some of their shareholding in the group level. They're now getting phone calls from the private equity backed platforms asking them, do you want to sell your shares to us now? Because obviously they know they're about to approach their own next capital transaction. So that's been quite interesting. There's a lot of partners that we've helped in the past sell. They're now letting me know that they're getting the phone calls from these private equity platforms trying to tidy up their cap table.
Yeah, I mean that's great, isn't it? And their transactions obviously works really well for everyone. The buyer's done well; they're moving it on, and presumably made money, and those sellers have got their earn out, and potentially, this is exactly what it's designed to do. They're going to get their slice of the next deal, which is great.
Yeah, absolutely. I know we've kind of referred to private equity transactions a few times during this discussion, but I think it's really super important as well for people that are, I don't know, they're 500k or 350k revenue businesses that they're either looking to sell or buy. I think often it's a perception of, we don't necessarily need a lawyer for those. We know someone that's done it before. We'll just use their contracts as a template and input it. And I just want to drive home that point or ask you to drive home that point on, it doesn't matter the size of the transaction. You do need to make sure that legally you're aligned and doing things in the right way to protect yourself.
Yeah, absolutely. Especially if you're buying a limited company, it doesn't matter the price of that company. You need to know what that company has done in the past, because you are taking on those obligations, those liabilities. So it doesn't matter if it only turns on over 350k. If it's been negligent, that company has given some negligent advice in the past, and you're buying that company, then you're getting that liability. You're taking on that responsibility to pay out that liability. So I understand. I get it. When you're buying a company and it might be just a small bolt on you're doing, you're thinking, okay, well, we're going to pay them this. Do I want to really pay a lawyer that? It seems a bit out of context. But what I would say is that it's money well spent to give you that protection of doing a full exercise, a DD exercise, understanding what's in there, and in the share purchase agreement, making sure that any risk is properly allocated to the buyer or the seller. Ultimately, we don't know what we don't know. If you don't look at something properly, if you don't have an expert look at it properly, if we didn't use an accountant or an auditor to look at our books and stuff like that and plan our tax,
Absolutely.
we don't know what we don't know. We wouldn't know what we're missing out on. So, yeah, I completely get how it can seem disproportionate to get a lawyer involved in very small transactions, but I think the right lawyer can approach it in the right way and say, okay, well, we don't need to do everything on this deal. We can just look at the share purchase agreement for you. We can guide you in certain aspects. We don't want to be disproportionately expensive.
Yeah, that goes right back to my comments at the top of this conversation about a commercially minded corporate lawyer, where you're not going to go in with a sledgehammer when a pen will do, for example. It's a case of look at talking to that client, understanding the dynamics of that transaction, and then, as you said, advising from there, saying, well, look, legally, these are probably the areas you need to concentrate on. We'd ideally like to do this for remote, but I totally get from a commercial point of view the cost versus the size of this deal. It might not marry up.
Exactly. Yeah, I think as partners in law firms, we're business owners, aren't we? So we get it. We have our costs and expenses, and we have to be proportionate to the size of the deal. The warning is that if you're buying a limited company for £1 or £1,000,000, that limited company can have something nasty in it. It doesn't matter how much it costs.
Yeah, absolutely. And then turning to engaging with a lawyer. Obviously, it's a very, very personal thing. It's a relationship, especially from a buyer point of view. You'd hope that they would go on to acquire others during their business journey. So it's about building that rapport and a relationship understanding between the lawyer. But from a seller point of view, it may well be their only time they're going to sell. So they need to make sure that they've got the right lawyer in place. And for me, I'm always quite open with yourself and other potential lawyers that we work with, that because it is a personal thing, you should always speak to at least two, just to get an idea of their relationships, the way they work, and obviously to get a quote as well, to say you feel comfortable. But from a client point of view, what do you think are the key points and considerations that any individual should make when they are looking to engage or make the choice of engaging a certain lawyer? Things that they really should be asking the questions of lawyers that they're talking to as well. I think that's probably an important point, because, as we said, you only know what you know, and maybe there's some business owners, accountancy practice owners, that are not sure of the questions they should be asking lawyers at the time when they're just seeking them out.
Yeah, I think expertise in the industry is important. More important in some than others. If you're in a regulated industry, it's important to understand that your lawyer understands the regulations and what the consequences of that could be in a transaction, whether or not you need FCA approval, etc. I think so. That's sort of given that you will ask those questions. In my opinion, personality is very important, especially if you buy side and you're going to be doing a lot of deals, sales side. Either way, you've got to get on with the lawyer and the team. You're going to be spending a lot of time on the phone, a lot of time in a meeting room. It's not an easy transaction. It's not transactions which just happen by email. I'll send you over the contract, you sign it. We spend a lot of time in a room with our clients, and on it, just like getting on with people level. I don't think you do well with someone you didn't get on with. I think you've got to have the comfort to think, when that phone rings and it's got your lawyer's name on it, I want to speak to them, not I don't want to speak to them, because you're going to have some very frank conversations. You're going to have conversations late at night, at the weekend, and it's really important that you get on with them. So that's one. Responsiveness, I think, is really important. It's across the profession, it's important, but particularly in corporate transactions, things normally go down to the last possible hour. Has the lawyer you're instructing got the capacity to do the deal? Have they got the team around them to do the deal? Because you might meet the partner once, but he's the only partner in the team, and there's no associates, no senior associates, no solicitors. Is he really going to be able to come back to you quickly on that SPA, or is he going to be dealing with other parts in his own business or with other clients? So I'd say you've got to look at the individual you're talking to, but also the team around them, because say someone comes to me, how professionals charge, you don't really want me drafting standard forms.
Yeah, absolutely. Yeah.
To form the board minutes, the written resolutions. What you want me doing, or the partner on the deal doing, is going through the share purchase agreement with you or the asset purchase agreement with you, and really adding value at that level. But if they haven't got a team around them to do the other stuff, then you're potentially paying that person to do that work, and it's going to affect whether or not they can turn it around at the speed you want to. So personality, responsiveness, and going back to the very first point you made on the podcast about the fear of instructing a lawyer, the fear of the cost, is it doesn't have to be just a range. Oh, we think it'll be about this, but it'll be what it'll be. We do, and I know other law firms are starting to do it now. We'll give you certainty of costs. We'll give you a fixed fee. As long as the parameters are certain and we know what we're dealing with, we'll give you that fixed fee. So the earlier you instruct us, the more you talk to us, the better value we are, really, to give you that comfort. You can pick up the phone, you can email us, you can call us, my mobile number at the weekend, and you'll probably get a response, and it's not going to end up in an extra cost.
I know we've certainly worked on a transaction over the weekend.
yeah, exactly. Had to get that one in.
Saturday and Sunday,
yeah, so exactly. But I think that's the nature of being a corporate lawyer and being, like yourself. It's just your clients. These are on sales side. These are potentially once in a lifetime deals for the clients. They built this business up, whether it be an accountancy practice, whether it be selling widgets. They built this up, and this is it for them. This is the most important transaction they will do, and if they need to talk to you, you've got to be available to talk to them. If they need something turned around, if possible, you've got to be able to do it. So they're the kind of 3 points: certainty of cost, responsiveness, making sure there's a team behind the person you're meeting, and personality.
Yeah. No, thank you, Paul. And thank you for today and coming on. I think it's been really, really useful to speak to you, and hopefully people of any of the myths that may be around legal representation has now been answered. Those that maybe didn't have a real good hold on what you would do as a corporate lawyer have got that now, and also those that maybe have acquired previously but not come across some of the pitfalls that you mentioned, or not kind of acknowledged the value on some of the documents that you would get involved in as well, and the role that you would play, have now got a good understanding there. Certainly, as we know, the accountancy practice industry at the moment, the activity levels on M&A are huge. It was very busy last year. This year has kicked off even busier, and I suspect that trend is going to carry on for certainly the rest of this year and probably into 2026 as well.
Yeah. When's it going to end? That's the question, I suppose. When's that?
Yeah. And that's the interesting question right now. That future gazing, if you like, into and seeing what the profession is going to look like in a few years' time. And I guess with everything we're already seeing those that maybe have been bought out by some of the consolidators that were not happy with the new infrastructure they're in. They're spinning out already and setting up their own, and the cycle starts again. But for me, I think the most interesting part is going to be the American firms coming over to the UK now that they're of certain size. It's not as fragmented as it was previously. And then you've got the likes of MHA, who I think yesterday floated on AIM and went that route. So that'll be interesting to see how that all plays out. For sure, it's exciting. And as I say to sellers and even acquirers now, I think for the first time in God knows how many years, the last 18 months or 2 years, the width and breadth of deals and the commerciality around the deals now, and being able to bespoke them and tailor them for the individual needs of the partners involved, and the opportunities there has never been like it has been before. You've certainly obviously seen that as well. I mean, previously it was very rigid with a third. We pay one times and that's it. But now, because of the different dynamics at play, you can. From my side, it makes it more exciting because you can really get in there and negotiate a deal that suits both sides.
Yeah, that's what you we want to be in, as that kind of advisors to the profession. We want to be in a place where we can add value and make a difference, rather than just cookie cutter a deal time and time again. We want to be getting the best for our clients.
Definitely, definitely. Well, look, thanks again, Paul. Appreciate your input, and we'll catch up soon.
My pleasure. Thanks, James.
Take care.